All right, everyone, listen to me closely. Every generation, and I mean every single one, believes it is smarter than the last. We think we have new technology, new insights, and a new way of doing things that will protect us from the mistakes of the past. We look at black and white photos of the Great Depression or watch documentaries about the 2008 financial crisis and think, that could never happen to us. We know better now. But I am here to tell you that this is a dangerous, expensive, and arrogant way to think. Financial history does not just rhyme. It repeats itself with ruthless precision, especially when we become complacent. The same patterns of debt, speculation, and denial that led to past collapses are alive and well today. On this very day, October 29th, 2025. People are taking on more debt than they can handle, chasing risky investments they do not understand, and ignoring the warning signs that are flashing brighter than ever. They are convinced that this time is different. But let me be clear, it is never different. The fundamental laws of money do not change. Ignoring them is like ignoring the law of gravity. Sooner or later, you will come crashing down. We must have the humility to learn from those who came before us. The most powerful force in finance is not genius, it is human emotion. It is the fear and greed that drive booms and busts. When times are good, greed takes over. We see our neighbors getting rich on stocks or real estate, and the fear of missing out pushes us to take risks we shouldn't. When the market turns, fear takes hold, and people panic, selling at the worst possible time. This cycle is as old as markets themselves. The key to financial security is not trying to outsmart the market, but to understand these cycles and prepare for them before they arrive. It is about controlling what you can control: your spending, your saving, and your mindset. So I am asking you to stop what you are doing and pay attention. I want you to push aside the noise from financial news channels that just want to keep you watching and the so-called experts who say everything is fine. We are going to look at one of the most reliable, time-tested indicators in all of finance. It is an indicator that has a nearly perfect track record of predicting economic trouble long before it hits the headlines. This is not about scaring you. This is about empowering you. Because knowledge is power, and being prepared is the only way to be truly secure in an insecure world. Now, I know what some of you are thinking. Suze, what on earth is a yield curve? It sounds complicated. I get it. The financial world loves to use jargon to make things seem more complex than they are. But I am going to break this down so simply that anyone can understand it, because you need to understand it. The yield curve is nothing more than a snapshot of the bond market. And the bond market is one of the biggest and most important financial markets in the world. It is where governments and large corporations go to borrow money. Think of it as the ultimate lending department for the entire economy. Let's talk about bonds. A bond is simply a loan. When you buy a government bond, you are lending money to the government. In return for your loan, the government promises to pay you back your original money, the principal, on a specific date in the future. Along the way, it also pays you interest, which is called the yield. So, a bond has a price, what you pay for it, and a yield, the interest you get back. These two things have an inverse relationship. When bond prices go up, yields go down. And when bond prices go down, yields go up. It's a seesaw. Imagine you are lending money to a friend. If you lend them money for 1 month, you might not ask for much interest. The risk is low because you will get your money back soon. But what if you lend them money for 10 years? That is a long time. A lot can happen in 10 years. Your friend could lose their job, move away, or have other troubles. To compensate you for that long-term risk and the fact that your money is tied up, you would demand a much higher interest rate. This is the fundamental principle of lending, and it is exactly how the bond market is supposed to work. A yield curve is a graph that shows you the interest rates, the yields, on bonds with different time horizons. On the horizontal axis, you have the length of the loan from short-term, like 3 months, to long-term, like 10 or 30 years. On the vertical axis, you have the interest rate for each of those loans. In a healthy, normal economy, the graph slopes upward. This means you get paid a higher interest rate for lending your money for a longer period. It makes perfect sense, right? More risk and more time should equal more reward. This upward sloping curve is a sign of economic confidence. So, if a normal yield curve slopes upward, what happens when it does not? What happens when this reliable common sense rule gets turned on its head? This is where we get to the heart of the matter. An inverted yield curve is when the graph slopes downward. This means that short-term loans are paying a higher interest rate than long-term loans. Think about that for a moment. The market is telling you that it will pay you more to lend money for 3 months than it will for 10 years. This is completely backward. It is a sign that something is deeply wrong with the economy's plumbing. Why would this happen? It happens because of fear about the future. Big, smart money investors, pension funds, insurance companies, global banks start to get very nervous about the long-term health of the economy. They believe a recession is coming. They think that in the future the economy will be weak, and the central bank, like the Federal Reserve, will be forced to slash interest rates to try and stimulate growth. So what do? They rush to buy long-term bonds now to lock in today's higher interest rates for as long as possible. They want to secure a 4% return for 10 years, for example, before rates fall to 1 or 2%. This massive wave of buying pushes up the price of long-term bonds. And as we just learned, when the price of a bond goes up, its yield goes down. It is that simple seesaw effect in action. At the same time, short-term rates might be high because the central bank is actively trying to slow down the economy to fight inflation. This combination of falling long-term yields due to fear and high short-term yields due to policy is what causes the curve to invert. It is the bond market screaming that the central bank's current policies are too tight and will eventually break something in the economy. An inverted yield curve is one of the most powerful and accurate recession predictors ever discovered. It is not just some quirky financial trivia, it is a serious warning signal. It tells you that the people who manage trillions of dollars are betting on an economic downturn. They are preparing for rough seas ahead by moving their money into the safe harbor of long-term government debt. When you see this inversion happen, you cannot, you should not, you must not ignore it. It is a financial fire alarm, and you need to start checking for smoke. If you think I am being overly dramatic, let's look at the facts. Let's look at history, because history leaves clues. The yield curve has inverted before every single United States recession for the past 50 years. That is a track record no stock market analyst or economist can match. It is not a guarantee, but it is as close to a sure thing as you can get in the world of finance. This signal is not new. It has been warning us for nearly a century. We just have to be willing to listen and learn from the painful lessons of the past instead of pretending we are immune. Let's go back to the Roaring Twenties. In the years leading up to the Great Crash of 1929, there was a frenzy of speculation. Everyone believed they could get rich quick in the stock market, but beneath the surface, trouble was brewing. The yield curve inverted in 1928. The bond market was quietly signaling that the party was about to end. Most people ignored it, caught up in the euphoria of the stock market boom. Then, in October 1929, the bubble burst, leading to the Great Depression, a decade of unimaginable economic hardship that scarred an entire generation. The warning was there, but it was drowned out by the roar of the crowd. Now, let's fast forward to a time many of us remember all too well, the lead-up to the 2008 global financial crisis. The housing market was on fire. People were flipping houses, taking out loans they could not afford, and believing that real estate prices could only go up. Banks were packaging these risky loans into complex securities and selling them all over the world. But again, the bond market saw the danger. The yield curve began to invert in late 2005 and stayed inverted for much of 2006 and 2007. It was flashing a bright red warning that the foundation of the economy, built on a mountain of bad debt, was about to crumble. Most people, including many top officials, dismissed the warning. They said the economy was strong and that the housing market was healthy. They were wrong. The inversion was telling us that the financial system was becoming dangerously unstable. When the housing bubble finally popped, it triggered a chain reaction that brought the global financial system to its knees, leading to the worst recession since the Great Depression. Millions of people lost their homes, their jobs, and their life savings. The yield curve saw it coming. The question is, are we listening now? Or are we repeating the same mistake of denial? So, let's bring this into the present. Here we are, on October 29th, 2025. What is the yield curve telling us right now? I will not mince words. It is screaming a warning. For well over a year now, the yield curve has been deeply and persistently inverted. In fact, this has been one of the most significant inversions we have seen in modern history. The difference between short-term yields and long-term yields has been at levels not seen in over 40 years. This is not a small technical blip. This is a five-alarm fire in the engine room of the economy. The reason for this is clear. Central banks around the world, including our own Federal Reserve, have been aggressively raising short-term interest rates to fight the rampant inflation that got out of control a few years ago. That took care of the short end of the curve. At the same time, global investors, worried about the impact of these high rates, have been piling into long-term bonds. They are betting that this aggressive rate hiking cycle will inevitably trigger a recession, forcing the Fed to reverse course and slash rates in the near future. They are preparing for the storm. What makes the current situation so concerning is the sheer level of complacency. The stock market has been surprisingly resilient, and many people have been lulled into a false sense of security. They hear talk of a soft landing, where the Fed manages to curb inflation without causing a major recession. But the bond market, the smart money, is telling a very different story. The bond market is saying that a soft landing is a pipe dream. The historical precedent is clear. When an inversion is this deep and this long, a recession has always followed. It is a matter of when, not if. We are facing a perfect storm of risks. Global debt, both government and corporate, is at an all-time high. The commercial real estate market is in deep trouble as remote work has become permanent for many. Geopolitical tensions are rising around the world, creating uncertainty and disrupting supply chains. And through it all, there is a pervasive sense that this time is different. Let me tell you, that is the most dangerous phrase in finance. The yield curve is telling us it is not different. It is warning us to prepare, and we must listen before it is too late. So you understand what an inverted curve is and that it predicts recessions. But how does it actually cause a recession? It is not magic. An inverted yield curve creates real-world problems that squeeze the life out of the economy, especially through the banking system. Banks are at the center of this process. Their entire business model is based on a simple concept. They borrow money short-term and lend it long-term. This is how they make a profit, and it is a vital function that keeps credit flowing to businesses and households. Think about it. A bank takes in your deposits from checking and savings accounts, which are very short-term liabilities. They have to pay you a small amount of interest on those deposits. Then they turn around and lend that money out for long-term purposes, like a 30-year mortgage for a family or a 5-year loan for a small business to buy new equipment. They charge a higher interest rate on these long-term loans than what they pay you on your savings. That difference, called the net interest margin, is their profit. This system works perfectly when the yield curve is normal and upward sloping. But when the curve inverts, this entire business model breaks down. Suddenly, the cost for a bank to borrow money short-term is higher than the return it can get from lending that money out long-term. Why would a bank make a 10-year loan at 4% if it costs them 5% to get the money in the first place? They would lose money on every single loan they make. It becomes unprofitable for them to lend. And when banks stop lending, the flow of credit, which is the lifeblood of a modern economy, begins to dry up. This is the credit crunch. Businesses can no longer get the loans they need to expand, hire new workers, or even fund their day-to-day operations. Families find it harder and more expensive to get mortgages to buy homes or auto loans to buy cars. The economic engine starts to sputter. Companies, unable to get financing, start to lay off workers to cut costs. Unemployed workers then cut back on their spending. This reduced spending causes more businesses to struggle, leading to more layoffs. It becomes a vicious downward spiral, and that, my friends, is what we call a recession. I did not tell you all of this to scare you. I told you this to prepare you. Panic is your enemy. Preparation is your friend. A person who is prepared is a person who is powerful. While everyone else is running around in a panic when a crisis hits, you will be secure, knowing you have a plan. You cannot control the Federal Reserve or the global economy, but you can, and you must, control your own personal economy. It is time to stop hoping for the best and start preparing for the worst. You must build your own financial fortress, brick by brick. The first and most important step is to get out of debt, especially high-interest credit card debt. Approved and signed. Debt is a thief that steals your future income. In a recession, when jobs are less secure, debt becomes an anchor that can pull you underwater. Pay it down as aggressively as you can. The second step is to build an emergency savings fund. I have been saying this for decades. You need 8 to 12 months of living expenses saved in a safe, liquid account, like a high-yield savings account. This is non-negotiable. This fund is your lifeline if you lose your job. Third, look at your investments. This is not the time to be speculating on risky assets you do not understand. Are you properly diversified? Do you have a mix of stocks, bonds, and other assets that align with your age and risk tolerance? If you are close to retirement, you should be reducing your risk, not increasing it. Remember the stories of people who lost half their retirement savings in 2008 because they were too heavily invested in stocks. Do not let that be you. Now is the time to review your portfolio with a qualified financial advisor. Finally, invest in yourself and your community. Your most valuable asset is your ability to earn an income. Strengthen your skills, get that certification, and make yourself indispensable at work. Nurture your relationships with family, friends, and neighbors. During tough times, a strong support network can be just as valuable as a savings account. People who survived past crises often did so because they could rely on each other. The warning signs are here. The yield curve is shouting. History is teaching. The question is, are you listening? Prepare now. Be strong, and you will be ready for whatever comes next.